You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always, and we're heading into the self-managed super fund space. We've seen it around. We've seen a lot of property spruikers pushing this and getting people into trouble. But we've also seen a lot of opportunity where smart people do harness the framework to use their SMSF as well when it comes to property. And geez, I got a lot of questions today because it's something that I personally am not very experienced in, having left my super the way it was for many years. But there is a man who knows exactly what he's doing when it comes to this. This is the National Head of Self-Managed Super Funds for Grant Thornton. It is Simon Gow. Simon, thanks very much for coming in and sharing your time, mate.
Thanks very much for having me, Trent.
Now, you're a tax man.
I am, yes, first and foremost.
Been doing that for a long time?
Yeah, best part of 20 years now.
It's very much an evolving space, though, isn't it? Self-managed super funds these days, I'm assuming, look very different to what they may have when I was a kid.
Look, there's increased regulation, increased compliance around SMSF. So, yeah, the landscape's definitely changed and people just need to understand the rules.
Before we do start this conversation, Simon, let's remind everyone that this is general advice and shouldn't be used as a substitute for personal financial advice. First thing I guess most people would be asking straight off the bat is, why would I use an SMSF? I hear my mate at the barbecue talk about self-managed super and I bought my property in this, bought the warehouse, I bought my office in it. What are the purposes? What's the point of taking out my super from my industry fund, putting it into a self-managed super fund, and then going and using it to buy a property?
Sure. So I suppose there's a number of reasons. Firstly, I'll just explain what an SMSF is.
Please.
So it's a private super fund run by the members themselves. So you can have up to 6 members in an SMSF now, so you can pool your superannuation together with family members or friends, for example, and you can really then tailor your investment strategy to the underlying goals and needs of the members themselves. So I think about things like the flexibility to decide what types of investments you want to make, the autonomy to make those decisions because you're the one in the driver's seat, you're one of the trustees, you decide. You're not having to go to a third-party retail or industry fund trustee who makes those decisions. You've got complete control. You're in the driver's seat. I think it also produces an element of engagement because instead of getting your statement every 6 months or once a year, you're actually there controlling the bank account, making those investments, going and buying that property. So you've got a lot of engagement with your super that you might not otherwise have.
There's a nexus there. There's a feeling like you got some control.
Yes, and then transparency because you know exactly how your funds are being invested for your retirement. So you can look under the bonnet and know exactly where your funds are. Whereas in other structures, you don't necessarily have that same level of transparency. And I think to your question about going and buying property, commercial property, residential property, it's really about that bricks and mortar. A lot of people understand those assets compared to other asset classes like shares or bonds, which might be a little bit more confusing for people to invest themselves.
Exactly, and I would have thought 99% of people in Australia who have their super accumulating on a monthly basis wouldn't have a clue where it is, other than what the super fund is, maybe.
Yeah, they might know they're in a balance fund. They may not even
remember. Yeah, exactly. Right. So they certainly wouldn't know the stocks and bonds that are being invested on a daily basis. But why would I use my self-managed super fund? But why would I set up a self-managed super fund to buy a property when I could just buy it in my own name or a company name?
Sure. There's a couple of reasons. So one is you may not have the cash flow to do it, the available savings, and you might find you have built up quite a bit of super. So it's both a funding consideration, but a second is a tax consideration. So superannuation, because the government's trying to enable us to save for our own retirements, makes income in super concessionally taxed. So the maximum tax rate for anyone that's complying with all the rules is 15% on the income. So the net rent is taxed at 15%. Longer term capital gains, so if you've held the asset for more than 12 months before selling, you're getting a 1/3 discount. So effectively that's a 10% tax rate on capital gains. And then once you get into pension phase in retirement, you can actually get 0% tax. So no tax on pension balances on the associated earnings on quite large amounts of capital. So it's now gone up to $2 million per person that you can start a new retirement phase pension in super.
So you're talking there about what really should be a long-term investment, right? I'm not trading property with my SMSF. Is that probably a good way to put it?
Absolutely fair. So the whole design of super is that it's there for your retirement.
So pick one and stick with it.
Oh, look, not necessarily. It's meant to be a long-term strategy with any type of investment most of the time, but I suppose it's going in with the right mindset when you make the investment. So let's say you've got that $3 million fund balance at that point in time when you reach retirement age. And so you can start a pension with $2 million. The extra $1 million is staying in that accumulation phase, that growth phase. So all of the fund's earnings on the $3 million are subject to tax, but the first, effectively 2/3 of that balance is tax-free of that income. And the extra 1/3 is taxed at 15%. So it's a pro rata base depending on your balance at that point in time when you start it. But the pension can grow naturally through earnings over time. So you do have to take a minimum amount out each year, but if your earnings on that same balance are higher than the minimum you're taking out, that pension balance will grow, and it's allowed to grow beyond that $2 million threshold. So it's more about the pension capital rather than the income. The income is unlimited if that had really good investment performance.
Now, we can borrow against this super balance, right? If I've got $500,000 in super, it's probably not buying me a lot in property these days. There are some lenders out there that would allow us to use that as our deposit, right? Our security to buy an asset that's worth much more than $500,000.
That's right. You can use borrowings in a limited capacity. So it's something called limited recourse borrowing arrangements, and they're quite different from a traditional loan. And it's all about being conservative. So when they design super and borrowing in particular, it's trying to ensure that you're not going off and buying assets that are going to blow yourself up and destroy your retirement. So they did make it quite conservative in nature. The whole idea of the limited recourse is that it's limited to the asset that's being acquired. So the lender's only recourse is the property that you've gone and purchased. All other assets of the fund are protected in that scenario. The lender doesn't have recourse.
Now, one thing that's flagging in my head there is there might be a number of properties that after paying interest, if I've leveraged my super balance into an asset, I might be negatively geared. Where would the money come from in that situation if I can't contribute it from, if that investment is supposed to be siloed? If at that point in time, that financial year, the interest on the leverage that I've added to my super balance to buy that property was $100,000, but my rent was only $70,000, how does that work?
Yeah, so that's really as part of when you're setting up the arrangement and deciding whether it's actually going to stack up and will the lender even lend to you. Do you have sufficient cash flow to fund the repayments? They may take into consideration contributions that you're able to make each year, knowing that you've got money outside of super to keep making those regular contributions. Or you might actually have separate assets in the fund that can still use the income to fund the repayments.
Got you.
The limited recourse is about if something goes wrong, the lender's recourse is the property itself and not those other assets. So you definitely do need to look at cash flow to make those repayments.
Now, I've heard that setting up a self-managed super fund isn't very easy and it costs a bit of money.
Yeah, look, it does cost a little bit of money. It's not that difficult. So the way it works is that you go and typically see an accountant. You probably need to involve a lawyer as well or through your accountant. So you set up a trust, a bit like a family trust for those that have got a family trust, and you have a trustee arrangement. It's often a company these days. You can have individual trustees, but we tend to see a company being used more often than not. So you'd set up a company in the company constitution, set up the trust, go and register it with the ATO, and then you can open a bank account, roll in your existing super, make your contributions, and go and purchase the investments. You do have to set up an investment strategy. So you're writing out a plan on how you're going to invest your super. That does need to meet certain requirements.
Could that be as simple as I want to buy a small warehouse that I'm going to rent out to someone?
That can be an element of the plan, but really you're looking at what's the risk and return, what's the cash flow requirements, diversification.
Yeah, what are my goals?
Considered that.
Yep.
Liquidity, that sort of thing. Can you fund your liabilities? Can you fund future pension payments? So probably needs to go beyond just, I want to buy this particular commercial warehouse.
So what is it going to cost then? If we're thinking about setting this thing up from a setup, but also an annual compliance basis. I know a few of our clients have got self-managed super funds, there seems to be more strenuous compliance requirements on an annual basis with their accountants asking for a lot of information, updating values and all that.
Yeah, the setup cost will vary a little bit depending on who you use and the trustee structure. So whether you have an extra company being set up at the same time, could be a couple of grand, $2-3 to set up the arrangement. You do have to pay ongoing accounting costs to produce financial statements and tax returns. You pay the ATO levy each year of $250, and you've got to pay to have it audited. So it would ultimately depend on what are you doing with your fund and how complicated it is, which would impact how much your accountant and your auditor are going to charge. But it could be $3,000 to $5,000 a year, perhaps more once you get into those more complicated funds with lots of complexity. To your point around increased requirements, things like valuations, that's all being driven by the ATO activity and auditors then coming to SMSF trustees saying we want more information to support valuations. So the ATO is always looking for objective and supportable data, and so they'll often want to see comparable sales or comparable rent that's being paid, particularly where there's related parties involved.
What I also know, Simon, is there are a bunch of rules around the why as well from a tax perspective. It gets a little bit complicated, but can we make it as simple as possible, explain that for us as to what might get in the way as to the parameters of what we could actually buy?
Sure. I guess the overall legislation's the SIS Act and the SIS Regs, the superannuation laws. And one of the primary tests there is the sole purpose test. So the idea that your money is being invested for your retirement or to fund death benefits if you die before you retire. So you've always got to have that thinking in mind when you're going to make investments and doing something with a self-managed fund. Are you doing it with the purpose of trying to generate future retirement benefits, or are you doing it because you're going to get a present day benefit, some kind of advantage presently before retirement? That's what the sole purpose test is trying to avoid.
The whole point is it has to be siloed, right? So if I go and buy a property or something that's going to have some least investment return, I guess, for a pension, that would be your dividend, let's put it that way,
Yep.
on an annual basis. I still can't touch that till I retire.
That's right. And so it's all preserved until you get into that retirement phase, and then you can start drawing down on that super. That's the whole point of superannuation.
I get a lot of clients asking if they can use their super to do a development themselves rather than just buy the outcome, buy the least investment after the development. So they want to go in there, buy a property, knock it down and turn it into XYZ. I've also heard that that's not allowable under the rules within SMSFs. Am I correct?
You're largely correct. I think it's really dependent on funding. So if you had a scenario where the super fund went out and bought the land and developed the site, paid third-party builders to construct it all, and did it with cash or other available investments, which is going to be pretty difficult for the majority of people, you could theoretically do a development.
The problem, therefore, is
the lending side of
got
things.
you.
So the whole limited recourse borrowing arrangements, you're only allowed to buy what's called a single acquirable asset. So you effectively need to buy a finished building.
Chasing rent, essentially.
That's right. And that's the whole conservative nature of limited recourse borrowings in super, is that you don't go and buy a risky development using your super with borrowings. It's going to blow your super up. That's the whole point.
I can't buy my family home with super, can I?
Certainly not.
Why not?
So again, the sole purpose test, you're not allowed to get a present day benefit. So if you're buying this asset off yourself, what's the driving factor there? You're either trying to get more money out of your super fund because you're skint, or you're wanting to live in the asset for free. You're getting a present day benefit from your own super. So you're breaching that.
So that's quite an interesting aspect to it, because I remember in the last election, Peter Dutton was trying to push that we could use super to buy a house.
Yeah, I mean, they're always looking for ways to make it easier for people to get into the property market without necessarily addressing the supply side of the equation.
So they would essentially have to change the legislation in order to be able to do that. That's the point.
That's right, to allow some kind, like the COVID situation where you're allowed to pull out $10,000 from super in that limited circumstance.
Is that still a thing?
No, I don't believe so.
What's next? What else should we ask about? Another example in my head, Simon, is I see a lot of people who will run a business making widgets or fixing widgets in Wangara. And what they've done is they've bought the warehouse in their super fund and they lease the warehouse to their business as if they're their own tenant, essentially. Why would I do that? How does it work? What's the point?
Yeah, so that's a pretty common arrangement we see with clients. So rather than going and paying a third-party landlord. They're sick of being a tenant. They want to make sure that the rent that they're paying is going to themselves effectively to fund their own retirement. So if they see that it's a good property, a good rental yield, it's going to actually produce a good retirement benefit for themselves, there's no reason why you can't have a super fund that's bought an asset that's business real property, so typically commercial property, being leased to a related business, provided it's at arm's length, market rates of rent, it's all documented through a commercial lease arrangement.
So you can't pump the rent up or lease it to yourself for nothing in the meantime?
It's all got to be as if you and I are in a contract together, treat your super fund exactly the same way.
I'd give you a discount, Simon.
You've got to be really careful with discounts in super, because you've got to remember that they're trying to ensure that you're not breaching contribution caps indirectly by doing these mates rates type arrangements. So that's the reason they're in place, and you just got to be careful that you're not breaching those what's called non-arm's length income or non-arm's length expenditure rules, where you end up with penalty tax.
You see people, owner-occupiers of their own workshop, right?
Yep.
But the point of putting it into the super is that they've got the tax benefits they're on. Essentially, they're paying themselves rent, but then not paying a full tax rate on the income that they're receiving from themselves. Can you give us some sort of example there using round numbers?
Yeah, so let's say they've got a business and they've got a commercial property sitting in their SMSF, and they might be in accumulation phase. They're not gone into retirement phase yet. So the super fund's going to charge rent at market rates, and it's going to pay 15% on that rental income coming in. But on the other side of the equation, you've got the related business, which might be a trust where the underlying beneficiaries are on the top tax bracket. So you've got a really significant tax saving there between those two entities.
Between the 15 and what might be 40-ish as an average.
That's right, yep.
Now, how does that work in residential property? It's a bit less clear-cut when it comes to buying something for a rental return.
Yeah, totally different kettle of fish when it comes to residential properties, when it comes to related parties. So the key distinction there is, and it comes down to that sole purpose test to a large degree, but you're not allowed to purchase a residential property from yourself or another related party, even if it's done at market value. It's simply not allowed. The second thing you're not allowed to do is to lease a residential property owned by the super fund to a related party, even if it's done at commercial arm's length rent. I think they're just trying to differentiate between what's a commercial arrangement and more of a private arrangement. And I think it goes to the heart of the sole purpose test that, are you more inclined to give yourself a discount or a family member a discount if it's them personally versus a commercial business arrangement? I didn't write the laws, so I don't really know exactly what the legislators were thinking at the time.
Now, if you were giving advice to your mate or your son at the dinner table around what you know around SMSFs and property, are there any loopholes here or smart decisions you can be making where you would use your knowledge to get a real win out of this? Or is it a really tight, hard to see any benefits situation outside of the very basic buy something and have that be your return rather than shares?
I think it depends on your own individual experience and skill set. Me personally, I'm not necessarily a property guy. I do invest in shares. But if you're somebody that really understands property and you can go and identify undervalued property and you think that could be a really good retirement asset, something that you hold for the long term, then yes, you could theoretically use an SMSF to go and make that investment.
The idea would be that because it has the most favourable tax treatment on anything you would invest in other than your family home, you'd want to put your best investment in that. Is that the idea?
Makes a lot of sense.
Yeah.
Yeah, definitely.
The only problem is you just can't benefit from it until you're 60-something.
That's right. You've got to have that delayed gratification and wait until retirement.
Just to clarify that delay, how young can I be to pull my money out of my super? When can I retire if I was ready?
So you've got to reach your preservation age. So for you and I, it's 60 or more. So you have to reach age 60. At that point in time, you can start what's called a transition to retirement pension, where you might want to start phasing down work and then supplementing your income with a pension from your super fund. But if you want to get into that retirement phase pension where it's got the 0% tax benefit, you actually have to retire after age 60 or at least cease some form of employment. You might go back into a different job later, but you're ceasing employment. Or alternatively, for somebody that's still working beyond 65, you can actually start a pension at that point, because under the SIS Act, you're retired at age 65, even if you're not technically retired at that point.
Isn't that funny? You hear the dream of wanting to retire at 40 or something, right? There's your one lotto. I'm retired at 40. I hear so many people come to me saying, Trent, this is my goal. I want to do property development for X amount of years, and then at 40 I want to retire. Seems like the super system doesn't really agree with that time frame.
It definitely wasn't catered for that, and that's where you've got to be careful about how much you're pumping into super versus into other investments outside of super. So I think about my own circumstances, and I'm trying to have a mixture of investments inside and outside of super, so that if I did want to retire a bit younger, that I could draw down on my investments outside of super first and then start to access super later. I've seen some clients get caught out like that.
Is there a way to pull your money out of your self-managed super fund early and just cop the tax issues?
No, it'd be a legal early release, and so it's more than just tax issues that you'd be looking at.
Penalties.
There's other penalties the ATO can apply, so certainly avoid drawing down on super when you're not allowed to.
So let's say I'm a regular 30-year-old fella who's excited about listening to this podcast, but I've got 200 grand in my super because that's what you'd have by that age if you've been working from your time you're 18.
Yep.
But I look at that and go, even if I was able to get a loan from a Liberty or something, it still doesn't let me buy a lot. And somehow my grandma left me $1 million. And I think I actually want to put that into my self-managed super. Can you do that? Can you top up your 200 grand with $1 million so you can then go and leverage to buy something that actually would be quite a sizable property investment?
Not quite $1 million on your own. There were the glory days of, I think, about 2006 where you could put $1 million in tax-free, and that's how some of these really big super funds came about. But these days you're really limited on your contribution caps. So you can do a 30 grand deductible contribution each year. You might be able to top up more if you haven't used your cap in the last 5 years, because your balance is under 500,000. You can potentially top up more. But to make those larger contributions, it's what's called an after-tax or a non-concessional contribution. It's 120 grand a year.
That's your max.
That's your max. And in that situation you just described, for someone on 200 grand of super, they could do 3 years worth in one hit, so 360 grand, but then nothing for the next 2 years. Huh. So you could get your $1 million in there, but it's going to take much longer. It's going to take several years with the contribution caps.
That really is quite limiting, isn't it? It really starts to, and this might be the point, but it limits your ability to maximise your outcome at the end of the day, and more seems to be tailored around just getting enough by the time that you get to a retirement age. It seems gone are the days where you could use the super system to really maximise your retirement. It's more about just hitting an acceptable amount of retirement, it seems. And anything else you want to do, you're going to have to do that through the proper tax system and deal with it now.
Yeah, government wants superannuation to be sustainable, and so you're starting to see things like this $3 million tax proposal, Division 296, really trying to scale back some of those tax concessions, which have been really favourable for a long period of time. So they've been winding back the concessions, winding back the amount of contributions you can get in there, because it's all about funding a reasonable level of retirement, weighing the tax considerations for the government.
It's really about replacing the government's pension scheme rather than trying to get rich.
Yeah, they're not trying to create really huge asset pools that are concessionally taxed that are then going to flow on to the next generation and also be concessionally taxed. That's not what super was designed for.
If I'm sitting here listening to this thinking, oh, maybe I need to get some help here, who do I speak to? An accountant? A lawyer? Is it you?
I'd say a combination. So get your team together. It's talk to an accountant. They'll probably involve a lawyer. Seek financial advice. You might need to go and see a financial advisor and work out a financial plan. Talk to guys in property that can help you get a loan if that's what you're looking to get into.
So a mortgage broker probably who understands SMSF as well. That's your team. Mortgage broker with SMSF, lawyer to help you write up contracts, accountant to help you set it up, and maybe a financial planner to build out that goal framework in the first place.
That's right. Yeah, so get that team together. I'd also encourage people to go out and read the free resources out there. The ATO's produced a number of publications on establishing, running, and even winding up an SMSF. So they're really good reading for those wanting to understand. And ASIC's Money Smart website also has a lot of helpful resources.
Oh, it sounds dry, concepts. Simon, I've got to be honest, mate.
You still need to go in with your
I'd rather just call
open.
You.
Please do.
Simon Gow, Grant Thornton, thanks so much for coming in, mate. Have a good day.
Thanks for having me, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!